tankers are coming to the U.S. Gulf and to Venezuela, we could really have a pretty significant increase in business for the American oil industry. I'm kind of surprised that the bond yield hasn't gone up more, but I think it still could. Today, instead of supply chain disruptions, we've had the tariff effect, and that maybe is about to wear off.
So if you had to be overweight bonds or equities this year, which would it be? We're speaking on the 13th of April. President Trump this morning announced a naval blockade of all vessels entering and leaving Iranian ports. And this blockade is now in effect. He warned that any Iranian fast attack ships in the area will be eliminated. He said that the U.S. will not allow Iran to export the world. Joining us now to discuss this and much more is Ed Yardeni, president of Yardeni Research, and he's been on the show before, Ed, many times, and we'll talk about his prior views. Link down below if you'd like to see our last interview with Dr. Ed. Good to see you, Dr. Ed. Welcome back.
Thank you.
You were on the show a couple of months ago, and you told CNBC on the 6th of April, which is last week, that you think the S&P had already bottomed. And indeed, the last week saw some of the biggest gains in the S&P in a single week for a long time.
Right.
Dr. Ed, today's events, meaning the U.S. naval blockade of the Strait of Hormuz, has that changed your perspective at all now that the rest of the world may see lower oil exports through the Strait of Hormuz? We know that there was already shadow fleets going through, but now a blockade is going to basically limit that going into Asia.
Right. No, I still think that March 30th, it was a Monday, the market took a big dive, and then on Tuesday, it rebounded dramatically when there was talk about the president looking for an exit strategy. And sure enough, Wednesday night, he gave a speech in which he said, it could last another 2 to 3 weeks, and the U.S. won, and if he had to declare victory and walk away, that was okay with him, and he's basically repeated that again recently. But you can't really invest based on what the president says day by day. It's a good way to kind of lose your investment mind because things change so fast. And he's speaking to a lot of audiences at the same time. He's clearly trying to convince the Iranians that he'll blast them to smithereens if they don't cooperate. And then when the markets don't cooperate with what he's doing, he tones it down, and then the market rallies on that. But I do think that the markets have been remarkably stable, even with this latest announcement that the United States is going to blockade Iranian ports. The markets have been remarkably stable in the face of all that. And I think investors are concluding that this too shall pass, and they're looking beyond it. And I agree with that view. Look, geopolitical crises have always been buying opportunities. A few months after Pearl Harbor, the U.S. got its act together and took out a big chunk of the Japanese Navy in Midway, and the market bottomed at that point. There was still a lot of war left in World War II, and yet the market did bottom early on. So the market is a discounting mechanism. I think in the current situation, the market anticipates that one way or the other, the oil will get out, the commodities that the rest of the world needs will get out. Very reminiscent of what happened in early 2022 when Russia invaded Ukraine. Price of oil soared, a lot of angst about whether there'd be a food shortage because grain couldn't get through the Black Sea, and somehow or other, everything kind of unfolded in a way that brought these commodity prices down. And the world economy and financial markets, unfortunately, have learned to live with this horrible war that Russia inflicted on Ukraine. And we could continue to have unstable conditions in the Gulf, the Arabian Gulf. But there is a pipeline from Saudi Arabia to the Red Sea, and if some of the stories that I'm reading on the internet, and the president's proclaiming that tankers are coming to the U.S. Gulf and to Venezuela, we could really have a pretty significant increase in business for the American oil industry.
Are you still maintaining your $7,700,
Yeah.
77 point S&P 500 by the end of the year call?
Yeah, actually, it's based on earnings this year being $310 a share for the S&P 500 and $350 a share next year. And I am amazed to see that the industry analysts are even more optimistic than I thought I was. They're looking not for 310. Right now they're looking for 320 this year, and they're not looking for 350 next year. They're looking for 370. I don't know what's going on, but analysts the past several weeks have gotten more bullish on earnings in the face of the war. And the analysts read the headlines the way we all do. They know there's a war going on. But at the end of the day, they get a lot of their guidance from the companies. And the companies are reporting, they reported really great fourth quarter earnings. And it looks like first quarter earnings are going to be up at least 12%. That's what the analysts are looking for now. And sometimes they tend to be too pessimistic about the latest quarter that we're in. But then for the second, third, and fourth quarters, they're looking for double-digit increases in earnings again. So they're very upbeat. So I was actually thinking of raising my earnings estimate before the war. Then because of the war, I held back and kept them where they are. And meanwhile, I'm watching the analysts who maybe didn't get the memo about the war having a negative impact on the U.S. economy and earnings. And so far, there's not much evidence that that's actually the case.
The NFIB Small Business Optimism Index, which is tracked by your website, Yardeni.com, that's been going down basically ever since 2025, but of course exacerbated by the Iran conflict. Do you think there's a disconnect between corporations and analysts on these corporate earnings calls being more optimistic and the rest of small business America here, Dr. Ed?
Well, optimism is a kind of a ambiguous idea. Are you optimistic or pessimistic? And I don't know if they're asking them, are you optimistic or pessimistic about your specific business or the business environment? And so you would think that all the uncertainty, and there will be an uncertainty index that comes out with the next NFIB data, which I guess is tomorrow, Tuesday, the April 14th, just to be clear about what day we're talking about. So uncertainty is clearly going to weigh on confidence. But at the same time, I'm a small entrepreneur. I've got my own business. And, if you ask me about things, I might say, well, I used to be more optimistic. Now I'm kind of leaning towards pessimistic. I don't like what I'm seeing geopolitically, but how's your business? Oh, it's great. And I'm actually hiring some people, and that's why I don't pay that much attention to that particular index. I pay more attention to their labor market indicators. Are they hiring or not? And that's a little bit more useful in at least thinking about the labor market.
Before we continue with the video, let's talk about a topic that's been on a lot of precious metals investors' minds: how to generate income with your gold holdings. Most assets either generate income or rely on price appreciation. Gold has traditionally fallen into the second category. Our sponsor today, Monetary Metals, has found a way that lets gold do both. Instead of just holding gold and waiting for price moves, investors can now earn a yield on it paid in physical gold. Through the leasing platform, investors can earn up to 4% annually with yield paid monthly in ounces. That means your holdings increase in gold over time. The metal remains in your asset base and can be redeemed at any time. Thousands of investors are already earning monthly interest in gold through Monetary Metals, so visit monetary-metals.com/Lynn in the link down below or scan the QR code here on the screen and make the most out of your gold today. Yeah, we'll come back to the labor market in just a bit. And also, this is an important chart. Their plans to raise prices relative to inflation, which has been coming up. But according to the blue line, percent planning to raise average selling prices. Is that lagging, Dr. Ed? Is that why it's not going up? Or do you just not anticipate this going up at all?
There's pre-war and there's wartime. I mean, well, let's see what the March data looks like. This was before the war. And before the war, I think overall you could say that inflation had come down substantially from its peak in 2022, but overall, consumer price inflation measures seem to have stalled out, coming down and settled around 3%, which is a full percentage points more than the Fed is targeting. And I think a lot of that had to do with Trump's tariffs. Trump's tariffs didn't raise inflation, but they kept it from coming down to 2%. I think we would have been down to 2% by now. Where Trump's tariffs had a big impact was on durable goods prices. Those prices had been negative on a year over year. Now they're positive. So again, the NFIB is a quasi useful indicator.
The 7,700 S&P 500 call, is that predicated on oil coming down, or do you think earnings will still remain positive if, let's say, oil doesn't move from current levels, which is near $100 WTI, even for the remainder of the year?
I think the U.S. economy can actually handle $100 a barrel oil. We are much less energy intensive now than we were, for example, during the stagflationary 1970s, where we got hit by two oil shocks, and those shocks spread very quickly to a broader inflation problem. Maybe that's less likely to occur this time. The economy is much more services. It's much more digital. It's less manufacturing, all in all. And yeah, I think the economy is resilient enough, which has kind of been my theme since the beginning of what I call the Roaring 2020s, is that don't underestimate the resilience of the economy. And sure enough, it's absorbed a lot of shocks, including this one so far. And I think it's going to continue to demonstrate its resilience by growing without going through a recession. That in turn will mean that earnings will be resilient, and that should continue to be the underlying bullish development for the stock market.
You actually have a three-stage framework that was outlined in this article by Benzinga. According to Yardeni, an oil supply shock moves through bond yield curves in three stages, and the U.S. economy has only reached page one. Stage one at $100 to $125, which is not even where we're at currently. Inflation fears dominate. Fed turns hawkish. At $125 to $150, the shock persists long enough that the growth fears start to emerge. Right. And then at the final stage, above $150, that's where we have real demand destruction, and the Fed actually turns dovish. So walk us through this framework here.
Well, look, I don't think it's a framework. It's really kind of descriptive of the shape of the yield curve, how the bond market is responding to oil prices. It's kind of hypothetical, right? I don't really have any hard evidence or an econometric model, which I don't view as hard to explain. You know, is it exactly 125 that things start to come unglued? But it's really just a way of conveying how I think the economy will respond to different price levels. And 100 to 125, I think the economy can absorb it, can grow. The bond yield might stay around current levels. The Fed probably wouldn't do anything in that kind of scenario because they'd have more inflation. Even if they see some slowing in the economy, it's not going to be enough to cause them to ease. And then, you know, you go higher oil prices, you have a different scenario. So it's not like we go, you know, stage one leads to stage two, leads to stage three. It's really, it should have been called scenario 1, 2, 3.
You have this piece from Yardeni Quick Ticks that I want to highlight. Apocalypse now, not lowering recession odds. You lowered your recession odd from 35% down to 20%. Tell us about why you did this.
Well, show the date again near the top there.
Yeah.
What do you have there? Like March 30th?
This is the date, April 7th.
Oh, April 7th. Yeah. By then it was pretty clear that. So again, we thought the market made its low on March 3rd. We said that. March 30th. We said that on the next day, on Tuesday. We said it Tuesday night after the market had that initial big surge, and we said that that's an important chart right there. That's the bull bear ratio that we're we give a lot of weight to, and we saw that the bearishness really had mounted, and from a contrarian perspective, so much bearishness with the bull-bear ratio down close to one, we concluded that there would probably be a policy response. When people get extremely bearish, the policymakers, one way or the other, get the message. And the policy response that developed, of course, was the ceasefire. We kind of moved in that direction at the time. And so I concluded that as a result of all that, and with Trump announcing that he was aiming for 2 to 3 more weeks, it was pretty clear that he wants to get out of there. Doesn't mean that there won't be some lingering forces there enforcing a blockade.
Yeah.
But I don't think it's going to be the kind of firepower we have there now. But that led me to conclude that the recession was less likely. A spike up to, over 125 was less likely. And that's the conclusion.
For somebody who's very bearish on the economy, like somebody on the bottom end of this chart, for example, what assumptions are they making about the war in Iran, or perhaps the war's impact on the economy, that you either disagree with or are just outright wrong?
Well, I've been talking about the roaring 2020s. I try to be reasonable, and I said that's my base case.
Sure.
I gave it 60% subjective probability. Then I gave 20% to an even better scenario, at least in the short run, which was a melt-up. So that's basically 80% for a bullish scenario. And then I had 20% coming into the war as the risks. And I really, when people ask me what they were, I wrote down. I'm kicking myself. It should have been obvious to all of us when the president was moving all that firepower into the Middle East. He wasn't doing it just for show. It was show and tell. If the show doesn't do it, then show and bomb, I guess, is really what it was. So my thinking was that that this war would, again, with the benefit of hindsight, we should have seen it coming. But I think that the economy is resilient. The inflation picture, I think, is widely anticipated to be, dare I use that word, transitory. I think inflation is going to be a little stickier than the markets are thinking. I'm kind of surprised that the bond yield hasn't gone up more, but I think it still could. But all in all, the alternative is the 1970s. So, if you want to kind of take historical analogies, the 1920s would be everything just works out, continues to work out. The 1970s is that we get a big shock, a bigger oil shock that's more persistent, that actually forces the Fed to go Volcker, and that is to raise interest rates to levels that cause a recession, to keep the energy shock from broadening out into the rest of inflation. And then an analogy I have yet to really talk about that every now and then crosses my mind is the 1930s, which was geopolitically just an uglier and uglier decade all around. I don't think it's going to be the 1930s. I don't think it's going to be the 1970s stagflationary environment. But that scenario I would put in the 20% bucket of everything that could go wrong, which I brought that bucket down in terms of subjective probabilities from 35% to 20%. Look, I use that as a way to kind of convey my how I see how seriously I take these scenarios, and it gives me a good way to communicate. So, if things go badly again, I won't hesitate to say, you know what, it's getting worse than I thought. And I've said that, we're looking at the fog of war. I don't feel comfortable being a military and trying to predict how this all plays out, because we see even military strategists don't really anticipate how things go. But I'm doing the best I can under the circumstances.
The CPI that came out last week, it rose 3.3%. That's the March number. That's the highest number since 2024, May
Right.
2024, driven by a 21% surge in gasoline and oil in a month-to-month basis. Now, to what extent do higher oil prices translate to higher consumer goods? You said earlier that we're living in an economy now that is not as dependent on oil as the late 70s was. So there is still some rollover from higher oil to other things,
Sure.
but to what extent?
Well, that's a good question, and I don't know the answer, so we can kind of do things on a relative basis. So
Yeah.
we can go back to 2022 when oil prices soared when Russia invaded Ukraine, and grain prices soared, and there was certainly some pass through, but there was also supply chain disruption. So it's not a clear analogy to the current situation. Today, instead of supply chain disruptions, we've had the tariff effect, and that maybe is about to wear off. We have yet to see that it actually wears off, but we don't have the inflationary background that we had in 2022. So maybe this one will be a more modest, shorter lived inflation spike. But I'm staying nimble on this one because I think there's too much consensus that this too shall pass. And I am somewhat concerned that it may take longer. Then again, in the roaring 2020 scenario, productivity just continues to get better and better, and productivity is a very powerful force in keeping inflation down. So I'm kind of open-minded on the inflation picture, though I do have a sort of an interest in my base case working out the roaring 2020s. So that's rooting for productivity being a big offset to these inflationary pressures. And the bond market seems to be aligned with that view right now.
Well, let's talk about the bond market. You said maybe the long end of the curve didn't go up, but the short end, the 2-year, went up about 50 basis points in a single month. You
Yeah.
coined the term bond vigilantes in the 80s. Are the bond vigilantes back now?
Well, they are in the 2-year notes, but 2-year notes are not bonds. And the bond
Okay.
vigilantes seem to be actually kind of asleep at the switch. If you want to see where bond vigilantes are working hard to push yields up, it's clearly in Japan. It's been in the UK. But here in the US, the bond market's been real quiet. I didn't think the bond yield will fall below 4% and this year, and it hasn't. I've been thinking 4.25 to 4.75%. And I still think there'll be enough of an inflation shock up ahead here and concerns that it's spreading that we will see 4.75%. But I would view that as a tremendous buying opportunity. I don't know if we'll get an opportunity the way we did in 2023 to buy them at 5%. Look, there's still a safe haven bid for bonds. People are buying bonds because they feel in a volatile world, if they just hold them for 10 years, they know exactly what they're going to get. And some people may prefer that. But the other thing to keep in mind is the world has actually become wealthier and wealthier. And as it becomes wealthier and wealthier, there's naturally a tendency to rebalance every now and then. So if a lot of people are making a lot of money in the stock markets around the world, they start to get nervous and say, maybe I should take some of my profits and put it into bonds, maybe even into gold, which of late hasn't been a great place to be. But I think the trend is still higher for gold.
The trend is higher for gold from $4,700. But what's your assessment as to why gold didn't move up on the Iran war?
Turkey.
Okay.
Yeah, I was kind of scratching my head, wondering. You have the war, you have inflation as a result of the war, you have bigger deficits as a result of the war, more pressure to increase defense spending, and gold goes down. And apparently, the story is that the war put a lot of downward pressure on the currencies of some emerging markets, particularly Turkey. And apparently, Turkey sold a lot of gold in an effort to prop up the country's currency. So that's one explanation. Nothing goes straight up. It's actually much better if it doesn't go straight up. If it consolidates, if there's profit taking, you get rid of the leverage in the trading, and then you find that lo and behold, they're still buyers. I mean, I think Chinese investors are still likely to be buyers because they've gotten killed in their investments in real estate. They've gotten whipsawed in the Chinese stock market. Chinese stock market is great for trading, but it's not for investors. It just goes nowhere fast with a lot of volatility. There's natural buyers. In India, they've always been buyers of gold and silver. And we've seen around the world people have been buying ETFs like GLD and things like that. But I think the excitement's kind of worn off for now, but it could come back. And I think a lot of my attitude view of gold is that it is a good diversifier in a portfolio. It has historically been inversely correlated with the S&P 500, but it's also had the same trend. So if my base case scenario of getting to 10,000 on the S&P 500 by the end of the decade, by the end of 2029 works out, I think the price of gold could get to 10,000 on rebalancing. People making so much money in the stock market that they want to rebalance into gold and into bonds, for example.
Do you think gold has now replaced or will replace bonds in people's
I
portfolios?
think I think people who didn't have any gold in their portfolio now have put maybe 5 to 20% in gold, and maybe that's as an alternative to bonds. But there certainly seems to be lots of demand for bonds, U.S. bonds, anyways.
Do you think the rising debt and deficit situation in the U.S. has put pressure on bond and treasury demand? This is an article from Fortune. I just want to get your evaluation of this. U.S.
Sure.
debt suddenly draws weaker demand as $10 trillion must be rolled over this year. So the past week, auctions for 2, 5, and 7-year treasury notes all drew weaker demand, forcing yields to go higher than expected. That's a stark contrast from last month when treasury offerings saw the highest demand ever in the history of 30-year auctions. This was dated March 28th. So not exactly new, but it was a couple of weeks ago.
Yeah.
Part of the reason later on, that the article later on goes on to explain is not just the Iran war situation, but also the fact that the funding for the war requires the deficit to be expanded. Do you think this impacts your outlook for bonds and treasury demand?
David, you probably you may know that I coined the phrase bond vigilantes
Yes.
back in 1983. And I think the previous time the bond vigilantes really kind of created some problems in the U.S. was in 2023 when the bond yield went from 4% to 5% in 3 months. It was August, September, October, went from 4 to 5%. And at 5%, people were starting to talk about 6% and a debt crisis and all that. I have in the past said I'll worry about a debt crisis when the bond market worries about it. So I got concerned. But then just as I was getting too concerned, the bond yield started coming down rather sharply at 5%. It was on November 1st. Bill Ackman said that he covered his brilliant short position in the bond market. He said, he'd made enough money there and he didn't want to play anymore. But he's very short term, obviously. But more importantly, the Treasury Secretary, Janet Yellen, basically announced that she was going to issue more in bills and not increase the issuance of bonds. She basically told the bond vigilantes, okay, I get it. I'm not going to stress you out by issuing more additional bonds. I'm going in the T-bill market. And so the bond vigilantes are not the only players in the bond market. There's the Treasury, there's the Fed, foreign investors, domestic investors. It's a whole bunch of players, and it doesn't always add up in a way where the bond vigilantes kind of call the shots. But right now, there's not much evidence that the bond vigilantes are getting agitated. If they do, and as I said, if we get a 4.75%, I think a year after we got the 5% in 2023, we got the 4.75%, and we didn't get the 5% because the buyer said, you know what, this is good enough for me. I'm going to jump in.
So if you had to be overweight bonds or equities this year, which would it be?
Equities.
Okay. Now, I believe, and correct me if I'm wrong, in December of last year, you ended a 15-year overweight on big tech. Is that correct?
Yeah, that's right. And also an overweight on the the U.S. Relative to other countries around the world. So yeah, that was a big call on our part. We also went underweight the Magnificent Seven at the time, which turned out to be a pretty good recommendation. And when the Magnificent Seven at that time, the forward P was about 32. When they got to about 25 a couple of weeks ago, we said, you know what? They're cheap. They're great companies. Let's go back to market weight, and that's worked out pretty well for us. With regards to tech and communication services, they got to 46% of the market capitalization of the S&P 500, and I just felt kind of uncomfortable telling people to overweight two sectors that already represented 46% of the S&P 500. If you just market weighted them, you were at 46%. And to tell people to overweight them was just, I thought it just didn't make sense that two sectors would just continue to gobble up market cap weight and earnings share. And that also turned out to be a pretty good call until the war started, because the market was broadening out to the S&P 493, and it was going increasingly global. Actually, I was late on the Go Global call. It was already happening last year, but it took me a while to kind of change my mind on that. And I think now, as the war is not winding down or ending, but as the markets are learning to live with it. I mean, the markets have learned to live with Russia and Ukraine at war. I think whatever ongoing problems we have in the Middle East may very well be something that the markets could learn to live with. Obviously, I'm assuming that, the best cure for high commodity prices is high commodity prices. That's one way or the other. Oil will get out of the Middle East, and if it doesn't get out of the Middle East, Trump will probably ignore the fact that more oil is being sold by Russia, and that more oil is being sold by the U.S.
The U.S. versus one here, the U.S. versus world call turned out to be a very good call, because the U.S. equities markets had the worst start to the year versus other global markets. Correct. For many years now. Are you shifting that view now, given that Asia depends on oil coming out of the Strait of Hormuz, as opposed to the West, and the U.S. in particular that doesn't really need it?
I was thinking about that, but before I could do anything about it, the markets decided to go right back into the go global trade. I mean, Korea kind of had an amazing V-shaped recovery. Taiwan, these are emerging markets, though they really should be developed markets. It's been the go global trade is kind of back in fashion. I'm going to stay with it. I don't do what trading calls very well. Every now and then I have a good one. But I like to limit them to when I have some conviction about it. Other than that, I try to have kind of long-term convictions on things. As you said, I was very bullish on technology and overweighting the U.S. stay home, as I called it, for a very long time. Now I hope I can find some themes to stay with also for a long time.
Well, I encourage people to check out Yardeni Quick Takes. So I have a subscription here, and I get these weekly updates on what I should be watching every week. Give us an update on what we should be...
It's actually, David, it's actually daily.
Daily update on what we should be...
That's the week ahead, but every single day we put something out. Then the idea is to help people understand how the macroeconomics, the geopolitics impacts the markets, and how the markets in turn have an impact on the economy.
What should we be focusing on this week for data that's coming out this week?
Well, it's actually a light week for data, but the producer price index comes out on Tuesday, and that'll be another kind of indicator of the extent to which the war in March affected inflation in March and the PPI. So clearly the energy components are going to be up a lot, and transportation inflation will also be up a lot. But I think, we probably aren't yet seeing a pass-through. But, companies learned how to pass through price costs so quickly in 2022, they could probably do it again. And maybe that'll be the shocker, is how quickly inflation does pass through and creates at least a short-term problem.
Okay. Well, excellent. Thank you very much, Dr. Ed. Tell us where we can find your work.
So as you said, you can go to yardeni.com, which allows you to either sign up for the institutional product or for the individual product.
Okay, we'll put the links down below, so make sure to follow Ed and Yardeni Research there. Thank you again, Dr.
Thank
Ed, for
you.
coming back on the show. We'll speak again soon.
Absolutely. Thank you, David.
Thank you for watching. Don't forget to like, subscribe.